Welcome to our deep dive into the dual engines of macroeconomic management, fiscal and monetary policy. These are the tools used by governments and central banks to navigate the business cycle, aiming for stable growth and controlled inflation. Today, we'll break down the math behind government spending, the mechanics of the Federal Reserve, and how these forces interact to shape the modern economy. First, let's establish the distinction. Fiscal policy involves the government's use of spending levels and tax rates to influence the economy. It's often debated in Congress and involves the federal budget. Monetary policy, on the other hand, is managed by the central bank, the Federal Reserve in the U.S. They manage the money supply and interest rates to achieve specific goals like price stability and maximum employment. Fiscal policy isn't always a slow-moving legislative process. We categorize it into two types. Discretionary policy refers to active, ad hoc changes like a specific stimulus package or a tax cut bill. Conversely, automatic stabilizers are built-in policies that respond to the business cycle without new legislation. For example, when the economy slows down, unemployment benefit payments automatically increase, providing a cushion for consumer spending. A central concept in fiscal policy is the multiplier effect. This is the idea that an initial dollar of government spending results in more than a dollar of economic growth. This happens because that dollar becomes income for someone else, who then spends a fraction of it. This fraction is called the marginal propensity to consume, or MPC. If you earn an extra dollar and spend 80 cents, your MPC is 0.8. To find the total impact on real GDP, we use the government purchases multiplier. The formula is 1 divided by 1 minus the MPC. Let's look at an example. If the MPC is 0.8, the multiplier is 1 divided by 0.2, which equals 5. This means a $10 billion increase in government spending could potentially increase the total GDP by $50 billion through subsequent rounds of consumer spending. Taxes also have a multiplier, but it's different. The tax multiplier formula is negative MPC divided by 1 minus MPC. Because it's negative, it shows that increasing taxes decreases GDP. Crucially, the tax multiplier is always smaller than the spending multiplier. Why? Because when the government gives you a tax cut, you save a portion of it rather than spending it all immediately. Direct government spending, however, enters the economy in full on the very first round. Expansionary fiscal policy often leads to budget deficits, where spending exceeds tax revenue. To fund this, the government borrows from the pool of loanable funds. This increased demand for money can lead to crowding out. As the government borrows more, interest rates rise. These higher rates make it more expensive for private businesses to take out loans for new projects, effectively crowding out private investment in favor of government spending. Now let's switch gears to monetary policy. The Federal Reserve, or the Fed, is the central bank of the United States. Its job is to manage the money supply, the quantity of money available in the economy. They do this to manage interest rates and hit macroeconomic targets. Central to this is the concept of money, any asset generally accepted for exchange or debt payment. Banks don't just hold your money, they lend most of it out. The law requires them to keep a small fraction, called the required reserve ratio, or RRR. This creates the money multiplier. The formula is simple, 1 divided by the RRR. If the RRR is 10%, the money multiplier is 10. This means every dollar deposited can potentially generate $10 in the total money supply as it's loaned out repeatedly through the banking system. Interest rates are determined in the money market, where the demand for money meets the supply. The supply of money is typically vertical, as it is controlled by the Fed. The demand for money is downward sloping because higher interest rates make it more expensive to hold cash instead of interest-bearing assets. The point where they cross is the equilibrium interest rate. If the Fed increases the money supply, the supply curve shifts right and interest rates fall. When the economy is in a slump, the Fed uses expansionary monetary policy. They increase the money supply, which lowers interest rates. Lower rates make borrowing cheaper for consumers and businesses. This stimulates spending on things like houses, cars, and new factories, which increases aggregate demand and helps the economy grow. It's essentially stepping on the gas. If inflation is rising too fast, the Fed does the opposite, contractionary monetary policy. They decrease the money supply, which pushes interest rates up. Higher rates discourage borrowing and spending, which slows down the economy and cools off inflation. This is often referred to as tapping the brakes to prevent the economy from overheating. How does the Fed actually change the money supply? Their main tool is open market operations, buying and selling government bonds. When the Fed buys bonds, they inject cash into the economy, increasing the money supply. When they sell bonds, they take cash out. They also use the discount rate, which is the interest rate they charge commercial banks for short-term loans. Lowering this rate makes it easier for banks to lend, expanding the money supply. We must also consider the long-term impact of these actions. The quantity theory of money suggests a direct and proportional relationship between the money supply and the inflation rate. In simple terms, if you increase the amount of money in circulation significantly faster than the economy grows, the value of each dollar drops, leading to higher prices. It's a vital reminder that while expansionary policy can help in a crisis, it carries the risk of inflation. Let's put it all together with a case study. Imagine a deep recession. The government might implement discretionary fiscal policy, like a massive infrastructure project. This spending is amplified by the 1 divided by 1 minus MPC multiplier. Simultaneously, the Fed performs open market operations, buying bonds to lower interest rates. Together, these actions boost aggregate demand from two sides. However, they must watch for crowding out if government borrowing gets too high, and they must be wary of the quantity theory's warning on long-term inflation. Understanding fiscal and monetary policy is key to understanding how our economy is managed. From the multipliers that amplify government spending to the Federal Reserve's control over interest rates and the money supply, these tools are powerful. Balancing them requires precision to avoid the pitfalls of debt, crowding out, and inflation. Thank you for joining this deep dive into macroeconomics.